India has long been hailed as the next big hope for global oil markets, a nation of nearly 1.5 billion people on the cusp of an industrial revolution, urban expansion, and middle-class explosion. For decades, energy economists and oil executives alike have been mesmerized by the idea that India could replicate China's meteoric rise in oil consumption. But as 2025 unfolds, the reality tells a more nuanced story. One where potential meets resistance and expectations meet complexity. From 2000 to 2025, China was the undisputed engine of global oil demand. According to the International Energy Agency, IEA, China added an average of 485,000 barrels per day to the world's oil consumption annually. It transformed from a developing economy to a manufacturing and industrial powerhouse, powered, quite literally, by fossil fuels. India, often dubbed the next China, has not followed the same script. In 2025, India's oil consumption is projected to increase by around 180,000 barrels per day, a 3.2% rise year over year. While that's not insignificant, it falls short of the once lofty forecasts of 300,000 to 400,000 barrels per day. Comparatively, China's oil demand is growing by just 135,000 barrels per day this year, its slowest pace since 2005, excluding the pandemic years, highlighting a broader deceleration in Asian oil markets. The logic behind the India-China oil comparison was based on a set of compelling factors: population size, GDP growth, urbanization, and industrialization. But despite ticking some of these boxes, India's oil demand trajectory is uniquely shaped by different structural realities. Urbanization is a critical driver of oil consumption. In China, over 64% of the population lives in urban areas as of 2025, compared to just 37.1% in. Urban populations tend to consume more oil due to increased transportation needs, industrial activity, and energy demands. India's slower urbanization rate has kept a lid on its oil surge. China's oil boom was driven by oil-intensive sectors: heavy manufacturing, steel production, and massive infrastructure projects. India's economy, by contrast, is heavily reliant on services: IT, finance, telecommunications, sectors that are much less energy-intensive. This fundamental difference explains why India hit the commodity demand sweet spot later and with less impact. The threshold for that sweet spot is around $4,000 in per capita income, after which commodity consumption typically explodes. China reached this threshold in 2001. India followed in 2006. Yet the explosion never happened because India's economic path diverged. Instead of smokestacks and factories, it invested in servers and code. India may have more people than China now, but it has a smaller labor force. As of 2024, India's labor force participation rate stood at 45.1%, significantly below China's 68%. Female participation is particularly low, with just 25% of women active in the workforce. A smaller and less economically active population means lower energy consumption overall. One of the most disruptive trends in India's energy landscape is the rise of electric vehicles, EVs. In 2020, EVs represented just 0.7% of total vehicle sales. By 2025, that number has jumped to 7.8%, a tenfold increase in 5 years. The government has set an ambitious target: 30% EV adoption by 2030. This shift is especially significant because two-wheelers, motorcycles, and scooters make up a large part of India's gasoline demand. Transitioning these to electric is relatively easier and faster than converting car fleets. In February 2025, EV penetration in the two-wheeler segment reached 5.6%. Additionally, the central government's PM E-Drive scheme aims to roll out over 14,000 electric buses by 2026, with major deployments in cities like Bengaluru, Delhi, and Hyderabad. These programs are directly eroding the growth potential of traditional fuel demand. The IEA forecasts that global oil demand will grow by just 740,000 barrels per day in 2025, down from nearly 1 million barrels per day in the first quarter. The culprits? A mix of slower economic growth, EV proliferation, and efficiency gains across sectors. The narrative is no longer about new giants replacing old ones. Instead, it's about the entire oil demand curve flattening. This changes the context in which India operates. The hope that it would fill China's shoes in the oil market may have been misplaced. India may be the world's third largest oil consumer, behind only the US and China. But its growth pattern is tamer and more diversified. China's rise as the world's workshop was aided by a globalization wave that welcomed low-cost manufacturing. Today, protectionism is on the rise. India is pushing for Make in India and Atmanirbhar Bharat, self-reliant India. But it's doing so in a global environment that's far less cooperative. For instance, when Apple announced plans to shift some iPhone production from China to India, the US political response wasn't encouragement. It was skepticism. Former US President Donald Trump even called for the production to return to America entirely. The era when the world embraced China's manufacturing boom has passed, and India can't count on the same goodwill. India is still a dream for big oil, but a dream constrained by new realities. It is growing, but not exploding. It is modernizing, but differently. The future of global oil demand may still include India, but the script has changed. It's no longer the sequel to China, but an entirely different story altogether. India will continue to play a critical role in the global energy landscape. But in an era of climate commitments, digital economies, and electrification, being an oil demand giant isn't necessarily the prize it once was.